Okay, so currency risk management has been the bane of a lot of candidates. There's what I call a pinch point. And once you kind of clear up the pinch point, what generally happens to the candidate is they say, every time I worked a problem, I got exactly the opposite incorrect answer. I never got the answer right. I thought I had it right, but I was exactly opposite what it should have been. And every time I hear that, I know that's that pinch point. And what I mean is the author, Bill Barker, didn't give you the key to success until like 68 pages in the reading. So he goes through all this material, and then about the last 4/5 of the reading, he lays it out and says, oh, by the way, this is what's really important to solve all these things, which is really kind of unfortunate. So this is what I want you to always be thinking about from a top level concept with currency risk management. If you think what we did in options and what we did in futures and swaps, we were managing the risk of a portfolio. The portfolio could have been equities, it could have been bonds. We used options, futures, and swaps to manage the risk. We either went long or short, any one of those different derivatives to manage the risk. When we turn the corner into currency risk management, I want you to think of ourselves as now owning a portfolio of two assets. You own a foreign stock or a bond, and the reason that you bought that stock or that foreign bond is because you liked it. You thought it had upside potential. So you went long. But in order to buy that foreign asset, you had to take your domestic currency and give it to the TravelX window at the airport and get the foreign currency instead to buy that foreign asset. So if we were to jump on an airplane with our US dollars in our back pocket and land over in Zurich, Switzerland, before we left the airport to get on a train to go up to Basel, because that's where all the Swiss drug companies are, we would need to convert our dollars over to Swiss francs. So now I own a Swiss franc, and I get on the train and I go up to Basel and I buy Novartis. Now I'm long a Swiss stock. So I'm long a Swiss stock and I'm long the Swiss franc. My portfolio has two assets in it. Both are long. Now, you might like Novartis for its demographic play, for its usage of, diabetes drugs and everything that it's got based on the demographics in that area. That would be like going long Pfizer in 1998 with the little blue pill because of demographics. Same kind of concept. Now, the problem is you like the asset. You like Novartis, you like the Swiss stock, but you don't like the currency. What can go wrong? The currency could lose value, otherwise known as depreciate. What makes a currency depreciate? I'm going to ask. Let's see. Ron, what makes a currency depreciate? Give me one dang good reason.
Inflation.
Inflation. Why is inflation negative for a currency, Ron?
Because the currency has to depreciate in order to have the quote, even out.
Parity condition?
Correct.
Okay, so if we stepped all the way back to the theory, purchasing power parity, absolute and relative, interest rate parity, we know that really the thing that creates differences in prices between one nation with a basket of goods and services and another is due to interest rates. So if I was to come up with a basket of cheese, wine, and bread in France and cheese, wine, and bread in Napa Valley, they really should pretty much be the same for the basket of the same goods and services. The reason that may not be the same is that interest rates are different between Europe, France, and the US. But what's very critical to recognize is it is this That is a critical equation for you to understand in this reading. That nominal equals real plus inflation. So inflation, when it goes up, it can make the nominal rate go up when there's no change in the real rate. Okay? And so as interest rates go up, the present value of assets falls. So bonds and stocks, when interest rates go up, because inflation spiked up, leads to a decrease in the present value. Think of the dividend discount model, the yield to maturity on a bond. However, if I was to change this and say, what if inflation was flat, but I increased the real rate? What would happen here? Ash,
So
you're smart.
based on uncovered interest rate parity, so we expect that the currency offset the increase in the real rate or interest rate.
So that would be correct. So what would lead to an increase in the real rate?
Higher rising economy, for example, or kind of
The labor, economic growth, labor productivity increase.
You have a tight monetary policy. If the monetary authorities come out and say, we're going to increase interest rates and we don't get a spike in inflation, that creates higher nominal yields. Now, when you have higher nominal yields, what does the bond market want to do with that? It's called the carry trade. So when you have one nation with higher nominal yields, with low levels of inflation, versus another country that has low yields and inflation, market participants love yields. They want income. They're going to drop their domestic currency. They're going to buy that foreign currency and buy that foreign asset, driving up its prices because it has additional income in the carry trade. And if you notice in that little transition that I just said, they dump the domestic and they buy the foreign. When they buy the foreign, it makes the currency appreciate. So you have to be answering the questions in this reading in this 3 parts: nominal, real, and inflation. When inflation spikes, you're going to have a currency depreciation. Asset values are going to come down. If inflation is flat, but monetary authorities are increasing nominal yields, that creates a positive carry trade, leading to asset price appreciation and currency appreciation. And that's exactly what happened early or late fall and early winter this last year. If you looked at Europe and its inflation and the US and its inflation, although both inflations were high, Europe was at 9%, we were at 6 to 7. Why was the US dollar so strong? Because in the global financial relative dance of asset valuations, ours looked more attractive with the US dollar not depreciating as much as a European, driving up the dollar and its strength. In the last couple of weeks, it's become a little bit weaker. Why? Because the whole debt ceiling argument. So I will say, this is my one political statement. I do not like people messing with my financial portfolios. And if this little group in Congress can't get their together, I'm going to drive over to the western slope of Colorado where Lauren Boebert works and lives, and I'm going to put a big heaping pile of stuff in a bag and light it on fire on her porch. Little. Anyway.
I'd note, Mark, you can actually have horse manure delivered. I looked into that. Didn't do it.
Okay. Oh,
But you can. But you can. Yeah, it's delivered. So you don't have to get your hands dirty anymore.
Hey, did you guys hear the story about Lauren Boebert's bar that was in Rifle, Colorado? So she had this bar in Rifle. Anyway, and I guess the people, some investors bought the bar and they decided not to renew the lease. So she was out of her bar. She doesn't have it anymore. They're not sure who were the owners or who bought the lease out of the building, but I don't think it was in the Republican Party. Anyway, nevertheless.
Mark, I think it would be more funny if you sent her that nominal formula you just had up and send her explain to her what happens if she doesn't get her act together.
There's more than one letter there, so she wouldn't get it. Anyway, I need to continue on. All right. So you have a portfolio, long an asset, long the currency. If the currency is facing inflation expectations, the currency will depreciate. Okay. So how do you hedge a depreciating asset, an asset that's losing value? You can buy a protective put on the currency. You can buy a protective put, or you sell a forward contract. In this reading, they don't do futures, they do forwards. Okay. So you short a contract on the currency or you buy a protective put. Now, here is the pinch point, and this is critical for you to understand. In the market conventions of currencies, there is a quote convention. And when we talk about the price divided by the base, it's how much we have to pay for 1 unit of the base in the price currency. Okay. So in the market quotes, in the general market of traders, when we look at quote screens, we are always, whenever there is a currency pair dealing with the euro will always be in the denominator. And I always think of that as the king. The euro is the king of all currencies. And that's Richard the Eighth right there. Is that the Richard the, or is it? Yeah, I think it's, no, it's Richard the Third. I'm sorry, it's Richard the Third. Now, if we take the euro out in any currency combination, and the only one that's then left is the British pound, the British pound will always then be in the base currency with every other currency except for the euro. If it's a euro pound, the euro will be in the denominator, the pound would be in the numerator. So I think of the pound as the queen. The next in the valuation hierarchy is the Australian or New Zealand dollars. So as long as the euro is out of the picture and the pound is out of the picture, with every other currency around the globe, now the Australian, New Zealand dollars would be in the base currency. And after that, it's the US dollar. Now you can see this in the reading right here. This is on page 141, 142. Currency pairs involving the euro will use the euro as the base. Currency pairs using the pound, whether it be the Swiss franc, the US dollar, or anybody else, then the pound becomes the base. The currency pairs involving the Australian, New Zealand, they go into the base with every other currency pair except for the pound and the euro. And then after that, it becomes the US dollar. So if you're dealing with the Mexican rupee, the yen is always in the numerator for the price, then it's always the euro, the pound, New Zealand, Australian, US dollar. Those are what are called market conventions. So in many questions in the reading, they give you the market quote convention. But you have to look at what asset did I buy, foreign asset, and what foreign currency did I buy? I'm now long. And the reading says that whatever you're long, you need to make that the base in the price to base quote before you make any decisions to go long or short a forward contract. So if in the question gave you the market quote and you were long a Hong Kong asset and you are a US investor, you need to put the Hong Kong dollar into the base currency and the US dollar in the numerator. You have to make the currency that you went long in the base of the price to base quote. Because if you do not do that, with regard to the spot and the forward value than what you thought to be in a contango market structure is in backwardation because you didn't invert the quote to put the currency that you're long into the base. And that's why you get it backward every single time. I can't hit that strong enough. Some questions you don't have to do it. It's already that way. The way the market quote is and what you bought is already in the base. Some questions you do have to invert it. So you have to look at that. Okay.